A warm welcome to all of you. Good morning, good evening, depending on which part of the world you're joining us from. And it's my pleasure to introduce the speakers for today. And we are delighted to have with us Mr. Ajay Bagga, uh, extremely distinguished market expert and financial private investor. Very distinguished career over multiple organizations like Citibank, has been the CEO and MD of um, asset management companies and has been on the boards of many companies, including the Financial Planning Standards Board of India. And he's been a wonderful guiding light and visionary for us here at Art of Living. And it used to delight me a lot when I started watching him on multiple financial channels on TV. But after a while, I just lost track. He's had over 1,000 TV interviews. His opinion is highly sought, and so we are really lucky to have him with us here to advise us on how we should look at investments at this very peculiar juncture. And in conversation with him, we have another very accomplished lady, a very accomplished professional, Sangeeta Shankaran. Welcome. And she's an executive director and CFO at Dun and Bradstreet. She's also a high performance coach, and she helps leaders perform to their potential. She's a speaker, a motivational speaker, as well as an author. And with that little introduction, I hand it over to you, Sangeeta, to take it forward.
Thank you very much, Smita. Pleasure being here, and it's wonderful to have Mr. Bagga here with us. And Mr. Bagga, so I would like to hear from you. Because of the global pandemic, most of the investors have seen their erosion in wealth, especially people who started building portfolios in the last, say, 4 to 5 years across all the asset classes. So what are your thoughts, and on when do you think this will recover to original levels?
Thank you. And thank you, everybody, for this opportunity to speak to you today. Delighted to be speaking to this gathering. I'll start, Sangeeta ji, with a brief outline of what has been happening in the previous couple of months. How is the economic situation? What is the reaction by global governments? Based on that, how are we seeing the present scenario in the markets? And then maybe some crystal ball gazing towards the end. So to start off, this started as a medical issue originating out of China sometime in December last year. And now it has taken the form of a pandemic, which is global. It is unprecedented. It is massive in scale. Any ways that you cut it, we are facing one of the biggest challenges. And probably like 1929, this would be the defining challenge for this century, is what most analysts are looking at. Where are we medically? We are losing a lot of people every day. Infections are increasing. We are waiting for the infections to start plateauing, which we are hoping that over the next month to 2 months, we should see a flattening of the growth curve of the infections. Most of the world is in lockdowns. India is in a very large scale lockdown where nearly the entire country, except for essential services, is locked down at home. In parts of the world where they were a little liberal or little late in starting the lockdowns, we have seen a huge spread of the infections, especially in developed countries in Europe and in the US as well. Today, New York has become, if it was a country on its own, New York has become the largest country in terms of infections and deaths. So it is a very sad moment for humanity. It's a big challenge. There is no known cure. The only mitigant is to maintain social distance and to ensure that you are self-isolating and avoiding the infection to spring from
Quarantine, yeah.
So that's on the medical side. So the difference between 2008 and now is that was a financial problem, an economic problem that came into the real world and caused economic disruption and wide scale job losses, wide scale economic losses, wide scale market losses. This time around, it's been a medical problem which has come to infect the financial markets, and from there it's going into the economies. So more because of the shutdown of the real world, we are seeing the economic impact and the markets impact, as against 2008, where the markets went down first and then they led to second order effects on the real world. That's the big difference, but the outcome is looking similar. How bad is it? It's already, in terms of job losses, for example, US has lost 17 million jobs in the last 3 weeks itself. That has reached the proportion of 1929. 1929 to 1935, the maximum the maximum unemployment rate had reached about 32%. We are at about 13% in the US as of yesterday, and that's as of last Thursday, reported yesterday. So if you add on this week, probably we are nearer to 17, 18% of unemployment. You add on the 8 to 10% who are not in the employment pool at all. It's a very grim scenario. Overall, in the world, we are expecting about 150 million jobs to be lost as a result of this economic lockdown that we are facing. And in terms of how soon will it recover, we normally look at these falls and recoveries as letters. So a U-shaped recovery is the markets go down, they plateau for some time, and then they start slowly recovering. A V-shape is a fast recovery. Ben Bernanke a few weeks back said he expects a V-shaped recovery. That might be true for the markets to some extent, but the economy is still going down south. Then there is the risk of Japanification, which is, Japan after the 1990 peak in its economy and markets never went back to those levels in terms of the Nikkei. So the automobile numbers, for example, in Japan peaked in the mid 90s, and they never saw those kind of numbers. So Japan has been in a slowdown, what we characterize as an L shape. So you go down and then you optimize at a lower level. That is a big risk. And then there is, of course, a lot of analysis that it's an inverted square root structure where you've gone down sharply and then you will plateau at that level, take a long time. And then when you rise, it will be a new normal. You will never come back to that old level, but it's not an L. So it's an inverted square root. So, you go down, you plateau, you fall off the cliff, and then you will kind of not maintain the whole V. So we don't know.
So do you see that repeating itself again right now?
Yes, very much. The economic issues are very huge, Sangeetaji. Economic issues are not going away. We're just starting that because of the job losses, because of the production not being done. You look at Indian Railways, for example, 15 lakh employees, and only cargo is being moved. So, hardly 5 to 10% of railways capacity is being used. No passengers. All the aviation companies globally, hardly any flights are moving. 95% flights have gone down. So you have a lot of fixed costs, industry by industry. And then the impact on the financial services, because countries have allowed people to defer payment of interest, payment of rentals, all property owners, all banks, all shadow banks, all NBFCs will face this issue of debtors not being able to service their loans for a very long time. So what we call the second order effects are just starting off. So economic problem will be widespread, will be more long.
It's also the cash flow issues, I think, right? Cash flow is the key for all businesses. And if they don't have enough cash reserves or investments to their credit, or, how do you think they are going to survive this crisis?
Yeah, cash flow becomes a very big issue. Last night, if you watched in the US, the Fed brought in a $2.3 trillion line. And largely that is for counties, for states, for municipalities. And a big portion is for small businesses to give them loans, to help them tide over this cash flow issue. because cash has become tight. The Fed from last September itself has been very active in the repo market, and they're putting something like $500 billion on a daily basis. Just to give you an idea, Lehman Brothers went down because JP Morgan pulled back a line of $15 billion and they went down 1.5. And Fed has been putting $75 billion in the US overnight market since last September. So, bond markets, we say, are the most comprehensive, most transparent markets. They were signaling for a long time that a recession is coming. We didn't know how it would come because everything was looking good and the governments were ready with all their firepower. When the yield curves inverted, so when the shorter yield is more than the longer yield, we say there is an inversion, because normally you should be paid more for a longer tenure. But if you get paid more for a shorter tenure, that's showing that the curve is inverted, that the market is expecting something bad to happen in the economy. And normally it takes 11 months. It happened. And we thought this time is different. It won't happen. We have reached a new normal with the amount of stimulus in the economy. But hey, presto, it's come to bite us at the right time. So biggest lesson I have learned is, respect your learnings and never think that this time it's different. We all were blindsided. But the big difference, and which is the optimism we have, is the central banks and governments have been very fast on the take. So US has put something like $6 trillion in commitments and in backstopping various markets in the US. You look at Japan, they just passed a $1 trillion stimulus package. So $1 trillion for a $5 trillion economy, you're talking of a stimulus of 20%. That's the kind. US is talking of a nearly $6 trillion on a $20 trillion economy. So you're talking something like 30% stimulus coming into the US. So these kind of stimuluses, another big learning we have in the market, never fight the Fed. So, but the market has fought the Fed in February, decided to fall off a cliff. Have we bottomed on March 23rd? Anybody's guess. We will know after a year. Normally, if you see data analysis, bear markets from the top to a sustainable bottom, on a median, they take 180 days plus. So 6 months they take. A bottom formation doesn't happen so fast. Bear markets, from the first time the bottom is hit to a sustainable bottom, the final bottom of that cycle, take about 71 days on a median. So the worst case could be that we are about 6 months from Feb 19th. So somewhere in August, on a median wave, we'll bottom out. Best case scenario is March 23rd, we bottomed, and 71 days from there, again on a median basis. So 2-3 months, we should be forming a sustainable bottom. One doesn't know. There are cases of 3 years also. 1929 had to wait till the World War II cleared out all capacities in the world, and very harsh solution came in the way of millions of youth getting killed. And that's when the markets came out and a new deal was needed. So we have a new deal. We are just not calling it a new deal. Central bank balance sheets will go from about $7 trillion to $20 trillion. So look at it this way. The world produces $70 trillion a year. Out of that, 20 trillion will be just the central bank balance sheets. It's unprecedented. So there's a huge stimulus, huge problem. We don't know what the result will be in the markets. We can guess at best.
So what do you think investors should do now? I mean, do they revisit asset allocation and shift investments? Would that make sense? So what are your recommendations?
So my recommendation would be multiple faceted. One is you have to sit down with a clean piece of paper, write down what is the cash you're having. And with cash, I mean cash assets. So what you have in the banks, what is your insurance coverage, what is your medical coverage. Then look at what are your liabilities. What all do you have to pay, like EMIs on house, on auto, children's fees, living expenses. look at your income, because there's going to be widespread income cuts. There's going to be widespread job losses. So you must look at your income and the coverage. With that, you come to what is your emergency, corpus. Normally, we say 6 months of emergency corpus is good. I think where the world is heading, I am pessimistic. I'm normally very optimistic, but now with the economy, how it's turning out, I'm a little bit pessimistic in a financial sense. I would say at least build up a corpus of 2 years. So even if there is a job loss, you have time. And how we very granularly, very easily explain this to investors is look at your financial savings in three buckets. So one bucket is for your emergency fund, your non-negotiable bucket. So your security bucket. So let's call it the security bucket. Normally 3 to 6 months of emergency money in it, a good term insurance. So you have a life insurance for your dependents in case anything wrong happens. Have a good medical insurance, not only from the company. Suppose the company job is not there tomorrow, what will you do? So have a personal medical insurance as well. Your car is insured. Look at all those. So your security bucket has your emergency pool. That I'm saying for the next 6 months now, put all your savings into that security bucket. Then you come to the investment bucket. Look at your investments. Are you diversified enough? So, one Yes Bank trouble does not derail your finances, or one PMC bag, or you're having perpetual bonds of Yes Bank, which you thought are very good, gilt edged, and then all of a sudden you come to know they are unsecured, and you will probably get a few cents to the dollar, maybe not that much. So relook at your investments. Right now, I'm not liking debt mutual funds at all. Reason being, next 3 months, even if somebody doesn't pay them, banks will not mark those people as NPAs. So how do you know what all is sitting in your debt mutual fund and what is current on its repayment, what is not current? They will not be allowed to tell you. And this could extend till December for all we know. Most of the developed world has moved interest payments to December. Italy has says don't pay mortgages. France has said don't pay mortgages. US has said there's a standstill till December, no need to pay. If you keep the jobs, I will pay on your behalf. US has gone one. We have nothing like that in India as of now. We don't expect because we don't have that kind of money, nor do we have a printing press like the US. So you have to protect yourself. I would say right now is the time to go very conservative. This is 1929 economically. If that comes through, the April to June numbers for GDPs will be very shocking because nobody is working. So if the global 2.5 billion people are just not able to go to their workplaces and work, there's no productivity. What is happening in terms of the so-called stimulus is a survivalus. It is surviving, helping people to maintain their survival lifestyle. It's not a stimulus as such. It's just hoping that zombie companies continue to function. Though they have no markets, they have no products, they have no productivity, but just giving you enough so that you can pay your salaries and the consumption economy continues to work. So it is a survival mode. Why should not you go into survival mode? There will be lots of people who tell you.
Does this also mean the interest costs will shoot up? Because if you are not going to repay the loans on time, what will be the impact on the interest? So would that brunt be more? So what would you suggest and what would you recommend? If people have enough cash, do you think they should repay the loans or they should just, buy in extra time and then repay it back with higher interest at a later date?
No, you should repay all your loans. If you have enough money, pay back that mortgage, pay back that credit card. Don't keep any loans because life is too uncertain. It's not worthwhile. And why do you take a loan? You take a loan for an appreciating asset. Auto loan I don't like because moment you come out of the dealer's shop, you are 40% down. You try to resell a brand new car, within a month, you won't get more than 60%. So it's a depreciating asset. Your house was supposedly an appreciating asset. Now we have something like 7 years to 11 years of inventory lying of houses. Who will come and buy your house and not buy from the market in distress sales?
Right.
You might have had a fancy number for your house. You won't get that. At least for the next 2 to 3 years, that residential real estate market is in big trouble.
So is it a good
So,
time to buy residential property?
uh, yes, if you don't have a property, your first property, it's a good time and bargain hard. Don't
Right.
touch anything under construction, anything without an occupation certificate, only ready where some people have already moved in. All the facilities have been given by the builder already. So it's not that I'll make the clubhouse later or I'll make the approach road. Some people have already moved. Why don't you move in? Don't touch those. Be very choosy. But this is a good time. If you want to buy your house, probably it's near the bottom. Maybe it will drag on for a year, 2 years. You can never get the bottom.
Right.
But it's a good time if you're sure of your cash flows.
Right. So what industries would you recommend? I mean, what industry should one opt for or avoid? Because, sectors like probably pharma, healthcare, insurance are probably the good time to invest in those. And then what about the IT and the finance sector? Would that diminish? What do you foresee in your crystal ball?
See, go and buy the general insurers. Warren Buffett said he's making so much money now because no cars are on the roads. In India, 800 people used to die of accidents every day. Every day. Now you're not having accidents because there's nothing on the roads except essential supplies. And there also, it has to be a moronic driver. Otherwise, the roads are so empty that you can't get into an accident. So the general insurers will make a lot of money, but on the motor insurance. But on the medical insurance, probably they will have hefty payouts coming up if it goes out a lot. So overall, yes, you're okay with insurers, mutual fund companies in India. Pharma is doing very well. It's coming off underperformance for more than 3 years, but now looks like pharma is doing well. Very difficult to call the sectors. What we know from past cycles is what was the top sector in the last turn will not be the top sector. So say financials are everybody's favorite. 30 to 40% of our market is financials. I'm not very sure, except for some very conservative, very smart managements who will manage to shine in this. Most of the finance have the dice loaded against them. People don't have the money. They will not repay. Microfinance, for example, you'll have very deep cuts in their loans. You will have problems in individual unsecured lending, which was a very good area. It was doing well. If people just lose jobs, how will they repay you? And then the government has allowed them not to repay till June. So I really don't know. And how will we analyze it if the companies say, look, I will tell you in September what is my NPA number, because till June, anyways, government has said it might be extended further. We won't have a clue. So financials, I would be wary of. FMCG consumption is an evergreen story. I would still recommend you can have some exposure there. But the best thing for the retail investor is start with the index fund, start with the index ETF, own the entire market. Let the market only decide for you. Why do you want to pay that 2.5%? There are some fund managers who are outperformers, but again, every 3 years they change. Who was outperforming 3 years back doesn't perform today. So it's not that, there are some funds with 20, 25 years history, but though they are not the same fund managers, they are not even the same companies most of the time. They got taken over, bought over by somebody else. And definitely India is not the same market. In 1993, when we started Kothari Pioneer Funds, and you look at some of those funds today, they're all sitting on Templeton books, massive outperformers, but there is none of those fund managers. It's not the same company. It's not the same country even. So I would say start off with the index funds, build up your prowess, and then slowly go into these actively managed large cap funds. What is very clear, stick with quality right now, stick with the large companies, because what we've seen is in these kind of downturn, the small companies don't have the staying power. They get hit very badly. Suppose, government doesn't pay one sector for even 3 months, they'll just get wiped out. Working capital costs will be very high. Everybody is constrained. Big auto players who are very cash rich are saying, I'm stopping paying my suppliers. Supplier is a very small guy, and then he has subcontractors in a big chain working for him. Think of the kind of damage that will do if one big auto major says, and all auto factories are shut.
So
You have
what?
these analysis coming that all auto put together has a less market cap than Hindustan Lever and more revenues, more cash. But what you're not seeing is, what if they don't produce for the next 3 months, 6 months? What if they're not able to sell, or they have a minus 50% sales year on year for the next 12 months? Will you go and buy a bike or a car right now? I don't think so. You will look at your job, you will look at just managing right now. And that's why I'm saying fill the emergency bucket. Investments bucket, we will look after later. Discretionary dream bucket, postpone it totally. We'll see. I don't see people being able to go for vacations for the next 1 year, 1.5 years. This problem has no cure. We'll need a vaccine. You will be foolish not to be maintaining social distance to the extent you can. So cinemas, aviation, just now DGCA has passed an order that flights in India will have to leave the middle seats empty and the last 3 rows empty. So there will be social distancing. Cinemas will leave alternate seats empty so that people stay. And who will risk right now? Will you take a vacation in Europe when you don't know what is happening with your service provider? I think 12 months we are going to see a very slow
Period.
period.
So what about the MSME segment? So do you think because of you gave a good example of auto. So the MSME looks like, they will be really hit. So how do you think they can, kind of overcome this and sustain their businesses in this time?
It's a very grim forecast for MSMEs. There was this recent study which came out about 6.3 crores MSMEs in India, and within 3 months, about 25% will be bankrupt. So most of them don't have more than 2 months of staying power. The good ones at the top, cash rich ones will stay, but at least 25%. So 1.5 crore firms will be bankrupt in the next 2 months. And we don't see an easy way out, unlike in the US, where they're actually Fed has stepped in and it's giving loans directly to SMEs, that so long as you keep your payrolls, and I will also, you don't have to pay the principal or interest, and I'll waive off the principal in case you keep the payrolls for the next 6 months. So they are trying to save jobs. They want, there's a US election coming in November. So you know exactly what the government wants. Government wants to be re-elected. The Fed wants the economy not to go into recession. And that's what's leading. Japan, if you see, is giving a huge stimulus to keep its factories running so people consume. And same with UK, same with Italy, France, all of them. And there's a big Eurobond issue which will come to bail out Italy. Just yesterday, the Europeans reached agreement finally. So for Spain and Italy, there will be a relief measure bond being issued. There's talk of a war bond in the US like 1945. There was a war bond issued. So, because US fiscal deficit used to be $1 trillion, which was already very huge, 4 to 5% of GDP. And now you're talking $6 trillion. There's no money unless you print it. But we know classic economics 101. If you have a lot of money chasing fewer goods, what happens? Boom, hyperinflation down the line, or big depreciation. So we don't know what will happen, but things are not too good. So I would say SMEs are particularly affected. Not too much hope in India in terms of government stimulus, because first, the money is not there. Second, the mechanisms are very poor to reach the SMEs. So there will be a capitalism kind of a shakeout that will happen in India. That's why I'm saying stick with the large companies. Survivors will do very well. They will eat market share of everybody else. But this is bad, like 97 Asia crisis. Uh, GE went out and bought a lot of companies at cents in that time. There will be a lot of funds. There's no dearth of private equity or distress funds looking at India and looking at picking up cheap assets. So companies will get revived ultimately. Equity investors will get finished, promoters will get finished.
So what about fixed deposit FMPs and PPF? Is it okay to invest in those, or leave them as it is? What would you recommend there?
Yeah, government issuances like PPF, post office, gilt funds, government bonds, tax-free bonds from government corporations, you're okay. So, but I'm not very sure of the credit funds, the duration funds. See what happened right now after the RBI rate cut, the 10 years went nearly down to 6%. Now it is 6.44. What is happening? RBI has allowed state governments to borrow most of their borrowing immediately. And state governments are borrowing at very high rates. It's squeezing out the markets. And the government of India yield curve also went up. If we print too much money, the rating agencies might come in and push us. We are just on the last rating rung of investment grade. If we lose one rating notch, we come down to sub-investment grade, at which point a lot of ETFs, a lot of debt funds can't invest in us. So the risk is very huge. And then you have the risk of the global economy. Exporters are in trouble. You look at logistics firms, a very little business, trucks, 60-65% of the Indian truck fleet is just sitting there. How will they pay their EMIs to all the transport finance companies? They don't have that kind of working capital available. So there will be a lot of write-offs. There will be a lot of loan for features that will happen, and much more pain before we get to some kind of semblance of order.
So what about gold? Do you think gold as a hedge can be built for up to say 5% or something of the portfolio in the next 1 or 2 years?
Yes, yes. By all means, buy gold. Don't buy too much jewelry. Buy the fake jewelry that is better, cosmetic jewelry. All weddings also, people are hiring the jewelry. I'll tell you one secret. I have a lot of friends in the gold loan business. Jewelers take us for a ride, except if it is a Bismarcked, with the BIS mark. Most of the 22 karat gold jewelry that we put in is hardly 16 karat. And the 18-20 karat ones is 12 to 14 karat. Most of the jewelry in India. Because it's a few micrograms difference between 0.999 and 0.9995 and all that. So in jewelry, you're losing making charges. You're losing a lot. There's a bid ask spread. What you can buy and what you can sell to the same jeweler, there's a big difference. Buy small coins from known mints with the BIS certificate along with it, or buy the gold funds. So you have gold ETFs available. That's better, no storage hassle, and for a small annual expense. Or there's the sovereign gold bond of Government of India, even better. You get 2.5% interest plus the gold appreciation. That's even better. So these options are there, but definitely gold will outperform. Look at it this way. Most of the currency in the world is now becoming fiat currency. 1971 was the last time US was backed by gold. So some French guy said, okay, I'm sending you some dollars. Can you give me gold? And overnight, Richard Nixon moved from the gold standard into the paper currency. So there is no gold backing up any of the currencies in the world that you think this has got some value. I would say three things. Gold, yes, buy up to 5%, 10% of portfolio buy. But look at what jewelry you are already holding and then look at your portfolio. Because jewelry will never sell. It will be passed on generation to generation. But that's an asset which is not really giving you cash flows. It's giving you appreciation. It's smoothing out your portfolio. Second, currency-wise, rupee goes down even further. So there's an undeclared currency war between all the countries in the world. US wants its currency down. Swiss bank for nearly 5-6 years has been holding a price because what would you buy? Earlier there was Deutsche Mark, there was yen and Swiss franc. These were the three apart from dollar, some in sterling. Now, euro, you don't know, are you Greek euro, are you Spanish euro, or are you German euro? So if there was a Deutsche Mark, you would have bought it. But euro, you're not so sure, though you buy a bit of it. So yen is being bought, dollar is being bought. There's not much other things you can buy. If you have a child who will go to study in the US, God grant that, or will be studying in UK or Australia, start sending that money abroad. You have 3-4 ways to do that. You have that liberalized remittance scheme under which you're allowed to $50,000 every calendar year. Make that at least that $200,000-300,000, which will be the cost of your child's foreign education. Don't keep it in rupees, because Manmohan Singh was 40 rupees. When I started working, rupee dollar used to be 8 rupees. 8 rupees. And if it went to 12 in 1991 liberalization, there was such a huge issue that we made of it. And look at it now, 76, 77. It will be 100 before you realize what's happening, maybe in the next 5 to 10 years. So 5 to 6% rupee depreciation, more or less, on the plate. So I would say there are funds which are, investing in the US markets. You can invest through rupee route. You can send money abroad through the LRS route. But your child's education money, just keep it separate and in that currency so that you are hedged against the rupee depreciation that we see.
Right, right. So what about bitcoins and cryptocurrencies?
So, Supreme Court has said that you have to make it legit, but government has not moved on it. Bitcoins, one or two of them might be legitimate. A lot of them are Ponzi schemes where, two people decide, and the technology behind it is easy to procure from certain countries who are known to harbor hackers. So people just announce a coin, XYZ coin, and then by trading within a close circle, they keep on jacking up the price. And like a Ponzi scheme, they bring in people. So someone says, I got in at $1, now it's $1,000. They made those paper money. If you can get out in time, like in every Ponzi, it's very good. Mostly, if you are thinking that the greater fool will bail me out, and you don't know who's the greater fool, what we have learned in the market, most of the time we are the greater fool. If you are looking for the greatest fool, then you are the greatest fool. If you don't know in the market that this guy is the greatest fool. So, no to Bitcoins, I would say. And too many scams of hacking. We had this case where the guy came to Jaipur and, God knows if he faked his own death or he really died, but he died keeping that password of the exchange with himself. So overnight, $400 million gone. That's the kind of risk. When you're going in public markets, there is a counterparty guarantee. The market has an investor protection fund. So your deals will go through. Bitcoin and all, you're really in uncharted territory. India is still not legit. So even if it becomes legitimate, please be very careful. Not more than 1% of your portfolio. Don't think that, I've got it all figured out. It will just crash. You don't know what will happen where.
Right. So considering the rupee depreciation that you mentioned, do you think it's good to invest in property abroad or offshore mutual funds? What is your take on that?
See, how I look at it, you can make a cash flow. We buy property for a lot of sentimental value. My wife and I keep seeing those Discovery Channel shows where, a house by this, see $500,000 in the US, and we say, oh, that will be great. But then you look at the insurance cost, the maintenance cost, how often will you go there? That is what I say when people say, I want to buy a holiday home. Buy a timeshare instead. Or if you just do a cash flow that I will be vacationing maybe on a very liberal case, 4 weeks a year, maybe 8 weeks, you will get tired of that place. There'll be a lot of hidden costs. There'll be a lot of other costs which you won't be, whichever European city we go, and we go with Gurudev mostly, so it's a very different, blissful experience. And we say, oh, we must buy a house here. And then when you go back, when he's not there, and
It's
you
not the
see
same.
the winters, and then you realize why people are so depressed with the sun going down by 4 o'clock.
Absolutely.
So it's not that simple. If you just do a cash flow, that even if I take two months every year and the best of hotels, how much will it cost me? Vis-a-vis buying and sinking that much money, I think you'll be better off taking the hotels. You can do that anywhere in the world, coronavirus allowing you. But here you'll be stuck. So like a holiday home, foreign property, no. Very big families, the ultra rich do buy. That's for getting a passport, getting citizenship, getting dual citizenship, all those things. That's beyond the remit of a retail investor.
And what about the offshore mutual funds?
Yes, those can be looked at. And there are
Okay.
these feeder funds in India which invest in US, Japan, European markets. So part of your currency hedging you can do through that. There are NASDAQ funds. There are NASDAQ ETF funds available. So you can have, Fidelity and Vanguard are offering zero cost funds. So even those are available. So you can look at those.
What about the commodities market?
Commodity markets is a bankruptcy market. It just ensnares people who go in, and most people lose their money. And not only us. I used to know one treasurer in one of the top 10 companies in India. And at the peak, this is about 10 years back, he had about 50 traders sitting, and he says, I'm the biggest consumer of metals in India. I'm the biggest infra, and I have set up this treasury. And they lost so much money that they promptly shut that down after 1 year of experimentation. A lot of Indian oil and gas companies, a lot of other companies have tried and failed. So what chance do you have as a retail investor? Some brokers do offer. Look at those services. If somebody is advising you, some professional is managing it. Otherwise, it's not easy. It's good for hedging. I used to have a lot of clients who were in the metal business, and they had desks sitting in India, Dubai, Frankfurt, New York, and Tokyo, who were trading through the day. But that's a professional trader and mostly hedging. So hedging their production costs so that they are sure of their profit. And then they will not look at whichever way. Some years you make windfall versus where the market is somewhere you lose out on gains. But what we would say is you're locking in your profit. So you're hedging. Hedging is different. Speculation is different. Commodity is a suicidal mission largely for the retail investor.
So since the rupee is depreciating, is it good to invest in IT sector?
Yes, it's a big export sector. I like it, and I made a lot of money in the IT sector, so I am quite, prejudiced in its favor. But good, clean managements, good operating margins, cutting edge. Now we are changing the business models to digitization, cloud, what we call ABCD, automation, blockchain, cloud, and digitization. So, naturally, it is a good natural competitive advantage, like generics in pharma. We have a competitive cost advantage, a labor pool advantage. So, yes, IT I would be keen on still.
And should we go in for futures and options?
Yeah, if you understand it, a lot of people make incomes out of it. A lot of people also lose. So something like 80% of the participants are loss making, 20% make money. The institutional player is always smarter because algos are running the market now, and algorithms based on computers. So you can never be that fast. Your platform can never be that fast. So it's a good hobby. Make sure it's 5% of your portfolio that you wager. and make sure that you have stop losses or you function on spreads so that, one position goes down, other is working, or you are curtailing your loss. Covered calls is a good way to play. Suppose you want to buy a stock, you can sell covered calls. So if it goes up, you buy the stock. If it doesn't go up, you collect the premium. So you bring down your cost of acquisition or you hedge. So again, F&O globally is used as a hedging mechanism. Very few people are using it as income generation. In India, all of F&O turnover literally is retailers trying to make incomes and getting butchered. That's the trouble. So 20% will make money, and 1 or 2% make serious money, but mostly it's a very difficult game. So when housewives start to want to enter, I've seen that in 2000, I've seen that in 2008 also, that in the investor camps, uh, housewives, and I'm not passing any comment on the intellect of the housewives, but there is a training, there is a time, and there is a temperament that you need to be in F&O. So unless you have the training, you have the time to spend on the screen the whole day, not that once a week you do 20 minutes, then you'll be parted from your money. But it's a good, if you can methodically learn it. A lot of people have given up jobs, sat, learned for a year, 2 years. It takes on average about 2 years to master it. So if you're willing to put in that 10,000 hours over the 2 years, it's a very good profession. It gives you a lot of independence and gives you a lot of returns also if you do it well. So I would encourage anybody wanting to do it in a proper methodical manner.
So what about the mutual funds, and do people continue with the SIPs? What is your take on that?
Yeah, see, we won't know which is the bottom and when will the market turn. What it will probably do, very highest probability next 3 to 6 months, it will keep going up sharply and then falling sharply, then coming up, then going. And people will say, oh, lower bottom is formed or higher top is formed. All that will happen. But that's how consolidation happens. So it's had a very V-shaped fall. It has had a half V kind of a gain, and you can say it's not in a bear market. Uh, I one doesn't know. So should you continue with your SIP? If your security bucket is full, you have 2 years of money in your pocket, 2 years of expenses, then by all means continue. If you don't, then this is a good time. Just discontinue, stop those checks going out. You might hate me 3 months down the line if the markets shoot up, but you have skin in the game already in terms of your old investments. What you must remember, why do we say not to disinvest? I'm getting a lot of calls now. Late at night, somebody will call, I met you in this investor camp. I put in X crores. Now it is X by 3 crores that is left. I'm very depressed. I'm thinking of suicide. All I tell them is just stop seeing the market every day. It will come back. That's the reality. No use booking the loss now at this rate. You down 30-40%. Obviously, you overestimated your risk appetite. So in bull markets, we think I can absorb this risk. In bear markets, downturns, our risk capacity goes down below the ground. We are not ready to take any risk at all. Here we have had banks failing. Imagine all the account holders of Yes Bank, what they went through for those 30 days.
Oh my
Thank God
God.
the money came back for everybody. Government of India, RBI should be congratulated. But, it was the fourth, fifth biggest private sector bank. You never thought, 2 lakh crores of deposits that were at risk. And the government, frankly, came in and bailed out a bank which made 18,000 crore losses on a quarterly basis. So we got lucky with Yes Bank. But what I keep telling is, please keep looking at the risk. We look at only the return and think that everything will be good. The whole world is not that good. It's a very harsh reality. Think of what all can go wrong. Like we buy insurance, same way we do diversification. So that, 3-4 eggs in the basket got crushed. Let me have 20 others which are running. Look at your cash flow.
Yes. So what about staggered equity? In the next few months, you think that is a good bet?
Yes, you can. Yes, you can. If you understand equity, again, if you have the time, you have the training, you have the temperament, consumption stories looking good, pharma stories looking good. Uh, so look at companies which have no debt, which don't lend also. Like banks will get hurt because they are in the lending business. So companies which have good cash piles, consumption stories, pharma stories, even IT, Accenture has said that they are, Cognizant has removed this guidance. So IT will suffer for 3 to 6 months. New orders will not come. Companies also will just look at maintenance, but most of our IT was value addition and maintenance. It wasn't product as such. So the Microsofts and all will find it difficult to sell products, but we'll be okay. We are services. So, we turn on the lights and we turn on the computers and make them run. Those will do well. Margins will come down, but then you get a 5, 6, 10% kicker through the rupee dollar because revenues are coming from the dollar side.
So is NPS good, the pension scheme?
NPS has done better than most funds. Uh, it's good. It's a good pension to have. 50,000 rupees is neither here nor there. One can look at it. It is locked in. So how I run my portfolio is, but again, that's a fund manager, CEO perspective. That I have run my own pension, my own buckets of money, which I've kept aside. I don't like to leave too much money with the government, and but I think for most of us, NPS makes sense, and we can put in that 50,000.
So do you foresee any hidden advantage for the markets in India in the long term? Let's say maybe because of the crude oil or, diversifying manufacturing from China, the future facilities of other, large multinationals, the manufacturing sector. Do you foresee any advantage that India will have in the long term?
Yes, there will be, but again, taking point by point, oil going down, we have not seen oil going down. The government has pocketed it. So rupee terms, it's the same rate as was, say, in the Congress when it was $110 at $20. You've not really seen the gain in the oil translating into the end consumer or end industry. So that's a myth that oil going down. Yes, at a country level, it helps the current account deficit. Our balance of payments gets better. We were paying $120 billion a year to import crude oil. That hopefully goes down 30-40%. That's very good for our balance of payments. Notionally, we are all richer, but not. Don't look at that. It's not. In fact, higher oil is better, makes us more productive. And globally, the markets are very strongly correlated to higher oil. So higher oil is better economy, better global stock markets. We tend to do better also. So not very strong correlation for us. Second part, companies moving here, our environment is still very harsh, very difficult at the junior bureaucrat level. At the ground level, setting up a factory in India, running a factory is very difficult. So there is reshoring by US companies moving out of China. Where has it gone? It's gone into Vietnam, it's gone to Mexico. Bangladesh has a higher textile export than India. Can you imagine? So basically, half of Bengal pre-independence India is producing more than Gujarat, Maharashtra, Rajasthan, entire South, entire Bengal put together. And that is because the governments have been very forward-looking. We need a very big make in India. It's still largely been limited to some pockets. It will happen long term, but don't get old thinking of those long terms. Think India, you have to think consumption stories, cost advantage stories, high growth stories, good managements. Those will deliver. Rest, don't look at these macro trends of India. Even the FIs who are largely top down, they have made money by going for consumption in India or growth stories like financials run by top class managements. They have lost money when the managements turned out to be rogues, as we have seen in few of the bank disasters or NBFC disasters.
Hasn't the ease of doing business in India become better? I mean, the score I thought has improved. So you still think there's a more scope to improve there?
Yeah, we should be in the top 10. Then, you can globally, we have improved that we were minus 20 and we have come to maybe, 9 or 10. We have to reach 1. So again, I'm saying at the top end, things are very good. So at the central government, even the chief ministers of states, their bureaucrats are very welcoming. When you start going down, the laws have not changed. You still need about 35 licenses to run a restaurant in India. It should be that you and your friend decide, I want to open a restaurant. Yes, cleanliness, hygiene. Maybe one or two agencies are overlooking you as, hotel administrating agencies. But you have to run around, get the fire guy, get this guy, get that guy. And then, we had this fire in Bombay. So many people died. And those same restaurants are functioning again. You go any night, you go to that same place, you can't walk. There are a lot of channel studios there. So I go for late night shows, 8 to 9 kind of India development debates and all. And you can't walk in those places. They're back again. So, and this is the center of Bombay. Just imagine what happens rest of the place. So it's a difficult situation. Running an industry in India is not easy.
From the chat, a lot of people want to know specifically with regarding to chemical and diagnostics, pharma, banking, and the construction industry. So, any specific answers on these sectors?
See, diagnostics, very good. But, look at the Supreme Court judgment of yesterday, where they have said private players also should be made to give free tests. Now, who can survive in business if you have to give any service free? So we were counting that there'll be a lot of scale up of this COVID testing, especially the antigen antibody tests will happen, and these diagnostic companies will be beneficiaries. But now, yesterday, this plug has come. So that is the trouble in India. The regulations and the regulatory environment. We have seen that in mining. We've seen that in telecom. We've seen that in a number of cases. And yesterday we saw it in diagnostics. So that will create some amount of cloud. Chemicals is actually 10 to 11 sub-industries, right from adhesives to agrochemicals to specialty chemicals to APIs to pharma inputs. So a lot of them, we have natural advantages. Just to give you a broad idea, China has a market share of 37-38% in global chemical industry, the whole chemical. We have a 3% market share. And we are as good as them in terms of the end product is very high quality we can make. Only trouble is we don't have scale, we don't have capital. So, and the MNCs have tried, but they found the entire ecosystem so difficult to operate in that they run away. Because what the Indian promoter can manage the local bureaucracy, MNC with all the anti-corruption, anti-bribery laws, they cannot manage the same thing. So laws will have to change, have to become more investor friendly, or capital will have to come. Either the government says that I'm willing to fund these promoters with very soft loans. We don't have a development finance institution in India who can do that role today. So somewhere, if we can provide them capital, we have very good promoters, very good companies. A lot of MNCs want to buy them out also. So we can do scale up with a special package. Banking, I already spoke about. I'm not liking it too much. I don't know how much will be the NPS. So, and it's not that we are very cheap or anything. PSU banks will take a very long time to really recover. So they might look cheap valuation wise, but that is because you don't know how much is still hidden in those books. So maybe one or two at the top end of the PSU banks might do well, but otherwise it's a difficult climb up from the
Okay.
historic entry.
Almost running out of time. So one last question. What would be your parting words for any investor, and what does your crystal ball say to all of us?
Yeah, no, it's please keep yourself first. Don't get taken in by these macro stories and 100-year stories. You have to manage your money today, diversify. Don't try to time the market. Be humble. Try to learn as much as you can. We are learning every day, every interaction. And diversification, make compound interest work for you. That's the biggest thing. So even fixed deposit, you keep on compounding it, and hey presto, you'll have a large money. Keep educating yourself. Read as much as you can. Hear as much as you can.
Awesome. So thank you very much for guiding us through this lovely talk. I'll ask Smita to take over from here.
Thank you, Sangeeta ji.
Wow, that's so much financial wisdom packed into 1 hour. That was a really brilliant conversation. Thank you so much, Ajay ji, and beautifully facilitated, Sangeeta. Thank you so much. Lots of comments. People want to know how to get more wisdom. So
Yes.
I'm going to suggest that they all follow you on your respective social media channels. I know Ajay ji writes some really fantastic articles out there. So please do follow them on their social media channels and you get more wisdom out there. So thank you all for joining us so much. And I'm sure you found a lot of value. And I think very beautiful that little thing of those 3 buckets, what you need for security and then the investment to grow the money as well as the dream that you have. I think that's a really beautiful concept to take away. So thank you so much once again for these beautiful insights, and we look forward to seeing you soon again.
Thank you. Thank
Thank
you.
And
you.
for
Thank
all
you.
our any other words to close, Ajay, or can I move on?
No, thank you very much, and thank you, Sangeeta ji. You brought out a lot today. Thank you.
Thank you. Thank
Thank
you
you,
very
Shweta.
much. Thank you. Bye.
So for all our friends who have joined us, this was such a power-packed session on financial health. The next one is on parental mental health. So this is called Just Kidding. Are you kidding me? You're working from home with kids, and we have an expert from education who led the setup of multiple educational institutions. Giving us tips on how to manage when you have kids and yet you're to work from home. So don't miss that one. And for more updates on what we are doing for you, please do look at our website, the corporate programs at artofliving.org, and more information is coming up on your screen shortly. Thank you once again, Ajay ji and Sangeeta ji. Have a lovely day or good night, depending on which part of the world you're from.
Thank you.